Hello and welcome to another lecture on basic macroeconomics. Today it is our lecture number 6 on basic macroeconomics, and the topic is macroeconomic analysis, sectors and variables. When we have to focus on performance of an economy, when we want to assess the performance of an economy, we focus on macroeconomic variables like GDP, per capita income, employment and their growth rates. At the same time, we have to focus on different sectors of an economy like the primary sector, secondary sector, tertiary sector, and we have to see how much each of these sectors contributes to the GDP or employment or per capita income, or for example poverty reduction. So in assessing the performance of an economy or in understanding the conditions of an economy, we have to take care of different sectors of the economy. And this very classification of an economy into different sectors becomes important for us. However, when we go for macroeconomic analysis, when we want to know how an economy operates, how it functions, at that time, when we are doing macroeconomic analysis, at that time we divide economic activities quite differently. The framework that we adopt to divide economic activities or an economy into different sectors is not the same as the one which we use to assess the performance of an economy. So in today's lecture we will focus upon macroeconomic analysis, sectors and variables, and the complete discussion will be completed in 2 lectures. In today's lecture we will be focusing on sectors only, and variables and many things that we need to know about variables will be taken up in another lecture, in next lecture. So in today's lecture our focus will be macroeconomic analysis, how we classify economy or economic activities into different sectors for macroeconomic analysis. Now over here you have on the screen a list of macroeconomic sectors of an economy. We divide an economy into these sectors when we go for macroeconomic analysis. Now if you read any of the books on macroeconomics, you will not find analysis in terms of primary sector, secondary sector, tertiary sector. You will find the analysis, different chapter scheme. If you look to the contents of a book, you will find this is the subject matter of the economics. These are the sectors which we take up for analyzing an economy, and it is these sectors from which we derive different variables which become very important for us while assessing an economy and its functioning. So we will focus first on these sectors, then one by one we will take up these sectors and try to understand some important things about these sectors. So we have here 5 sectors. The first sector is the household sector, then we have business sector or the production sector, then we have financial sector and government sector, and finally the external sector. So to begin with, we have to memorize that, we have to keep in mind that there are 5 major sectors of an economy, or we can say all economic activities are divided into these 5 major categories that take place in an economy for the sake of economic analysis when we want to know how an economy operates, how it functions. Now let's move to the first sector, that is the household sector. Now what is household sector? Now we as individuals in our day-to-day life, we act as consumers, and our families, a big component of our economic engagements is about consumption. And consumption means when we are purchasing goods and services to satisfy some of our wants, and those goods and services are not utilized for further production. That is, we use final goods and services to satisfy our wants and not for further production. That is what we mean by consumption, and that is what is actually included in the consumption sector or household sector. Now we must not get confused about this very thing, that in the household sector there are different people, and in the business sector there are different people. A single person can have both the engagements. He can be part of the household sector, and at the same time he can be part of the production sector. So when a person he is consuming goods and services, final goods and services to satisfy his own want, he will be called as a consumer, and he will be at that time included in the household sector. He will become part of the household sector. Or we can say, in other words, when he is engaged in consumption of goods and services to satisfy his own want, he at that time belongs to the household sector. However, if the same person he is engaged in utilization of goods and services, but for the sake of further production, at that time he is participating in the production process, and therefore he will be included in the business sector or the production sector. So this thing needs to be kept in mind. Now let's come to the household sector. The household sector, its major preoccupation obviously is consumption of goods and services, final goods and services to satisfy its own wants. Now, when we consume goods and services as consumers, obviously we need to make payments, because every economic activity bears some price, and we have to pay that very price. Now, when we make the payments for goods and services that we utilize, this is called as consumption expenditure on part of the household sector or on part of the consumer. So this term needs to be kept in mind, and we designate this consumption by the symbol or alphabet C in macroeconomics. So this needs to be kept in mind. However, a question arises, and that is, where does the income for the household sector come from? For the consumption come from? Now, the household sector, actually, the common people, you and me, we own the factor services, we own the factors of production, and these factors of production, these factor services are then utilized by the business community to produce, or business sector to produce goods and services. Now, while goods and services are produced with the help of our factor services, obviously we are given remuneration, which we call as factor payment. So the factor services that we give to the business sector, in return the business sector gives us factor payments, and that very factor payment becomes an income for we people, part of which we spend on consumption of goods and services, final goods and services. Now, there are various types of services that the household sector provides to the business sector or the production sector. For example, household sector provides labor, and for labor the remuneration is wages. In return they get wages. Similarly, household sector can provide land or building. You and me as individuals, as common people, we can have land or building which we will rent out to someone for production purpose, for business activities. Now, at that time, obviously we will receive remuneration for that as well, and that very payment will be called as rent. Similarly, the household sector also has savings at times, and these savings, this money is invested, for example, by a business person. Now, the business person will pay the remuneration of that very capital or the money that you lend to him, and that very payment will be called as interest. And finally, the household sector, in household sector we have people who act as managers, who provide their entrepreneurship to the production sector, and these people get the profit. So these are the types of factor services that are provided by the household sector. 4 factor services are very famous, and then they get 4 different types of factor payments in lieu of the factor services that they provide. Now, when the household sector gets its income, and we now are conversant with the sources of income for the household sector, the factor services that we provide to the business sector. Now when we get income, we usually do not consume all of our income. We don't go for the expenditure of all of the income. The part of income we consume, we make expenditure on consumption of final goods and services, and part of it we keep as saving with ourselves. Now, the part that we keep with ourselves as saving, the household sector saves money. That money goes to the banking sector, to the financial sector. It lends that to the financial depositors that in the banking sector, and banking sector in turn gives that money, lends that to the business sector, and business sector invests that money. So that means the savings that are done by the household sector are ultimately translated into investment through the medium of banks or financial institutions on part of the business sector. So this is how the business sector, so the financial sector links the household sector and the business sector. Now, what is the relationship of household sector with the government. Household sector, obviously it receives income, and in a modern welfare state, obviously it has to pay taxes on that very income. Now household sector therefore pays taxes. Also there are different types of non-tax payments made by the household sector towards the government, like registration fee, so on and so forth, and thus the household sector contributes to the revenue of the government. Now in return, the government pays back to the household sector through subsidies or through transfer payments or provision of goods and services, which are as amenities for the household sector or consumption sector. So this is the relationship between household sector and the government sector. One makes payments, contributes to the revenue of the government, and the government in return provides different amenities or funds or money to the household sector in different form. Now subsidies means that a particular thing, its price is, for example, 10 rupees, then the government pays part of the price and you have to pay only part of the price. Similarly, transfer payments actually means that the government provides, for example, to old age persons or unemployed youth or widows, it pays them some money to run their life. Therefore, and in that case, the people who receive the money, for example, the old age people or the widows or the unemployed youth, they don't do anything for the government in return. So this type of unilateral payment on part of the government is called as transfer payment. Now let's move to the next sector, the business sector. Now as we understand the business sector, the main activity of the business sector is the production of goods and services, and there are various sources of demand for goods and services of the business sector. Now three of them are most important, and we can in a way categorize all the sources in these three groups. First is the household sector. Whatever is produced by the business sector or the production sector, a major chunk of it is consumed by the household sector to satisfy their personal wants. So this is one source. Another source is that government has to provide goods and services to various sectors, including the household sector. At that time, obviously, the government buys goods and services from the business sector. Similarly, the external sector or the foreign citizens from other countries or governments from other countries, organizations from other countries may also need different goods and services which are produced by our country, for example. So at that time, the external sector also becomes a source of demand for the business community of our country or of any country. Now obviously the production sector or the business sector produces goods and services, and it sells its goods and services in market and through markets, and it receives revenue. And that very revenue is very important because it is partly used for investment and it is partly used as remuneration for the services provided by the household sector. Now part of it is also given to the government in the form of taxes. So that also becomes very important. At the same time, the business community, business sector also takes loans from the banks or financial institutions and then makes investments. And as I said, it also pays taxes. And at the same time, it can receive subsidies and even transfer payments from the government sector if the government feels it necessary. Now let's come to the third sector, that is the financial sector. Now what is the financial sector includes both banking and non-banking financial institutions that we will take up in coming lectures as a special chapter. Now over here we are concerned with the main function of the financial sector or the banking sector. As I said earlier, the banking sector actually connects the household sector and the business sector. The household sector, it makes savings and then deposits that savings in the banking sector. The banking sector lends that very saving to the business sector, and business sector obviously makes investment out of that, and the business sector, they pay interest rate to the banking sector for the credit and loans they take from the financial sector, banking sector, and the banking sector in turn makes interest payments to the household sector. Now the amount of interest they charge to the business community, to the business sector, is higher in comparison to the amount of rate of interest they pay to the household sector. And this very margin between the interest rates they charge to the business community and the interest rate they pay to the household sector is this margin is used as a profit, and this is how the financial sector runs. This is their profit margin actually, and this is how they pay their employees' salaries and develop their infrastructure. At the same time, the financial sector also it can pay taxes. They pay taxes, and they are also they also receive subsidies at times. One of the important things that we need to keep in mind about the financial sector is that every country has a financial institution, the central bank, which supervises the monetary aspects of an economy. So they look at the money supply, the amount of money supply that needs to be kept in an economy, or the rate of interest that needs to be kept in an economy. So all these things are decided by the central bank for the proper functioning of an economy on part of the government, representing the government. Now let us move to the government sector. Now the government sector, obviously, from an economics perspective, becomes important because it has its revenue generated from an economy. So it generates its revenues through taxes and non-tax methods, and then it has the expenditure side as well. It makes expenditures on different things like the goods and services. It can also go for investment. Goods and services are provided to different sectors if the need arises, or if the government thinks it reasonable, because we live in a welfare state system. Therefore governments do provide goods and services to different sectors so that their life becomes easy. And at the same time, governments can make different sorts of investments. The mega projects at times are actually initiated and run by the governments. Therefore investment is also one part of the expenditure. Then they provide subsidies and transfer payments, etc., to different sectors, particularly to the household sector. So there are various types of categories of expenditure that we have for the government. Therefore, and the revenue and expenditure side is actually presented in a consolidated form through the budgets, annual budgets, by almost every government in a year. And it can also be provided through the plans, 5-year plans, 10-year plans. What the revenue sources are for the government, and how these funds that the governments amass, that the governments collect, are to be spent on different aspects of an economy. So that also happens. Now let us come to the final sector, that is the external sector. Now an economy has economic relationships with rest of the world, with other countries as well. So particularly there are exports and imports. Then investments also take place in organizations, individuals, and even governments make investments in other countries. So there are economic relationships between one country and rest of the world and other countries. So we call it the external sector. So the economic relationships that are beyond one's borders are included in the external sector. Now the primary economic relationships include exports. Now when a country goes for exports, it exports its goods and services. Then obviously it receives dollars at that time, it receives foreign currency at that time, and there is inflow of income or inflow of currency for an economy, and which can be an important component for an economy, an important ingredient for the functioning of the economy. At the same time, a country needs imports of various types. Almost every country needs imports, and while doing imports, bringing goods and services, demanding goods and services from rest of the world, obviously money outflows, income outflows that goes out from an economy, and that also plays a crucial role for the functioning of an economy. Now there are two types of investment. The rest of the world can invest in a particular country, and a country can invest in rest of the world, its citizens, organizations, and the government as well. Now there are two types of investments that are made. One is the foreign direct investment, and second is foreign institutional investment. So rest of the world, other countries, other citizens, other organizations can invest in, for example, in our economy, and investing in such a way that they establish a firm, establish an office, and run the business by themselves, supervise the business by themselves, or supervise the production process by themselves. So in such a case is called as foreign direct investment. So when a foreign citizen or a company or government it makes investment in other country and then supervises the business by itself, then that very investment will be called as foreign direct investment. Other form of investment is foreign institutional investment, which actually means that the foreign citizens or companies or governments, they buy shares of a company of a particular economy without going there, establishing their office, and without actually supervising the production process or business out there. So that very sort of investment is called as foreign institutional investment. For example, you buy shares of a particular company through share market. Now you get the shares, and the company, if it progresses, then you get benefited, and if the company doesn't progress, there may be loss to you as well. But in this case, a person doesn't come to the country where his business actually is operating, and he doesn't participate in the management and operation of the business. So this type of investment is called as foreign institutional investment. Then there are exports and imports, and when we have exports and imports on border, the goods and services, or goods particularly, they cross the border. While crossing the border or coming in and going out from a border, obviously it has to pay, the businessmen have to pay taxes, which we call as tariffs, or there may be quotas, that is the limit on the quantity of a good which can be imported from other countries, or at times which can be exported to other countries. So these are also important ingredients for an economy, because while we change tariffs and quotas, these systems, then it also has tremendous impact on the functioning of an economy, its growth rates, per capita income, and so on and so forth. At the same time, an important ingredient of the external sector is the remittances. So from in this country, people, the citizens of this country, may be in different parts of the world, different countries, working there and sending part of their income to their home country, to their families, and this is what we call as, this income is what we call as, these funds is what we call as remittances. So remittances can also play a very important role, depending upon the quantity of remittances that are actually flown back to a particular country. Remittances can play an important role for the functioning of an economy, and the way it is easy for an economy to make progress, or it is not easy in case remittances are very low. So remittances do play an important role for an economy. Then we have the concept of balance of payments that is associated with the external sector. So as we said that trade of goods and services, inflow and outflow, exports and imports of goods and services, and investments in domestic economy by foreigners, and in foreign countries by domestic people, citizens, or organizations or governments, and then inflow or outflow of remittances from an economy or to an economy. There is a huge chunk of money flowing in and flowing out of an economy. So there's a system to track this inflow of money and outflow of money, which we call as the balance of payments. It is a 1 year summary statement of all the transactions and money flows from an economy into an economy from the external sector. So that also becomes very important for us. Now these are the 5 essential sectors of an economy. We talked about the household sector, then the business sector, then the financial sector, then the government sector, and finally the external sector. Now we need to keep these things in mind because this is the framework that we utilize to understand the functioning of an economy. Macroeconomic analysis is based on these five sectors and the variables associated with these five sectors. And in the coming lecture, we will be focusing on the variables, and you will locate their existence in any of these five sectors, or maybe simultaneously in more than one sector at times. And this is very important for us to keep keep an understanding of the framework that we employ for macroeconomic analysis using these five sectors while trying to understand the functioning of an economy. Do subscribe to my YouTube channel, Nest Economics. Thank you very much.